What is a dividend aristocrat? A dividend aristocrat is a company in the S&P 500 index that not only consistently pays a dividend to shareholders, but annually increases the size of its payout. A company will be considered a dividend aristocrat if it raises its dividends consistently for at least the past 25 years. Some aficionados of dividend aristocrats rank them according to additional factors such as a company's size and liquidity. For instance, having a market capitalization in excess of $3 billion. Let's talk about these royals, okay? A company is a dividend aristocrat if it increases the dividend it pays to shareholders for at least 25 straight years. A dividend aristocrat must also be a member of the S&P 500, and some investors may add additional screening criteria. They tend to be large, established companies that no longer enjoy supercharged growth. Many are largely recession-proof, enjoying steady profits and growing dividends in good times and bad. Dividend aristocrats are similar to dividend kings. That's right, I said dividend kings, which are firms increasing dividends annually for more than 50 years. Now, if you stay tuned to the end of this video, I will share with you some of those aristocrats. Companies that are able to maintain high dividend yields are relatively rare, and their businesses are usually very stable. They tend to have products that are recession-proof, allowing them to keep taking in profits and paying dividends even while other companies are struggling. There are usually fewer than 100 dividend aristocrats at any given time. In 2021, just 65 dividend aristocrats were listed among the S&P 500. They can be found in many sectors, including healthcare, retail, oil, gas, and construction. Startup companies and high flyers in technology rarely offer dividends at all. Their management teams prefer to reinvest any earnings back into the operations to help sustain higher than average growth. Some fledgling companies even run at a net loss and don't have the cash on hand to pay dividends. Large established companies with predictable profits are better dividend payers in general. Many do not enjoy regular, robust growth or a constantly rising stock price. These companies tend to issue regular dividends as an alternative way of rewarding their shareholders. Analysts have many ways to evaluate dividend aristocrats as investments. They include the growth of the stock prices of companies over time, their resilience to downturn in the stock market, and their expectations for future prosperity. That means there's an ever-changing hierarchy among dividend aristocrats. These guys are trying to stay there. Once you get there, you don't want to be knocked off of that pedestal. Forbes selected its top dividend aristocrats for 2021 based on its expectations of the company's total future returns. Note, these choices, particularly ExxonMobil, were made prior to 2021's collapse in oil prices sparked by the spread of the novel coronavirus. 65 stocks meet the criteria required to be dividend aristocrats in 2021. Some examples include AT&T, ExxonMobil, Walgreens, AbbVie, IBM, 3M, and Caterpillar. Two ways to track the performance of these stocks include the S&P Dividend Aristocrats Index, and the S&P High Yield Dividend Aristocrats Index. A company that pays out an ever-increasing dividend is ideal for investors looking for stable income, and being such a company is a positive signal that the firm is on sound financial footing. Remember, however, that a dividend is a portion of a firm's profits that it is paying to its owners or shareholders in the form of cash. Any money that is paid out in a dividend is not reinvested in the business. If a business is paying shareholders too high a percentage of its profits, it may be a sign that management prefers not to reinvest in the company given a lack of growth opportunities. Therefore, a dividend aristocrat may be squandering growth opportunities or not have any such opportunities to redirect profits. Moreover, company management can use dividends to placate frustrated investors when the stock isn't appreciating. That said, if a dividend aristocrat is able to grow the payout it gives to shareholders on a regular basis, it does imply some organic level of growth in order to fund those payments. Pros and cons in investing in dividend aristocrats. 2 pros are: it provides stable income for shareholders, and it's a positive signal indicating strong financials. 3 cons are: dividends may be paid in lieu of growth opportunities. Dividend stocks may produce lesser capital gains, and dividend payments are taxable events, which means when you receive those dividends, you do have to pay tax on them. But we're dividend investors. We know that. Similar to dividend aristocrats, dividend kings are companies that are known for paying dividends consistently over time as well. While a dividend aristocrat must be a member of the S&P 500 and have an increasing dividend payout over 25 years or more, to qualify as a dividend king, a firm must only meet one hurdle, and that's paying an increasing dividend consistently for at least 50 years. Some dividend kings will also be dividend aristocrats, and not all aristocrats will be dividend kings. For instance, they have not been around for 50 years or are not in the S&P 500. It is less common for companies to consistently increase their dividends for over half a century, so the number of dividend kings tend to be fewer than their aristocrat cousins. This is where the stock market puts the world in perspective. Okay? For example, a dividend king, the Tootsie Roll Company, has increased its annual cash dividend for 54 consecutive years and has paid continuous quarterly dividends for even longer than that. In general, companies have dividend policies that fall into 3 categories: a stable dividend policy, a constant dividend policy, or a residual dividend policy. If a company has a stable dividend policy, the shareholder can expect steady and predictable dividend payouts every year, regardless of fluctuations in the company's earnings. If it has constant dividend policy, the company pays out a percentage of its profits to shareholders every year, so investors experience the full volatility of company earnings. If it is a residual dividend policy, the company pays out in dividends whatever money remains after it has taken care of its capital expenditures and working capital. Well, that about wraps up this video. And if you find value with the stuff that we're talking about, please subscribe, like the video, and hit the alert button so that you'll be alerted when we put a new video out. Thanks for watching. Hey, Dividend!